Getting back to the markets, as we're seeing this continued rise in the major averages and in the equities markets on the back of that CPI print, rising just 0.1% in November, below the expected 0.3%, which is the smallest increase monthly in over a year. Joining us now to discuss, we've got Joe LaVorgna, who is the SMBC Nikko Securities America Chief Economist, alongside Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder. Gentlemen, thanks so much for joining us in studio today. A lot to get to. Lakshman, I want to begin with you because you say that this is really rear view mirror type of data that we're looking at, and it is. So where do you believe that inflation is heading from here, given this print that we saw, and does it suggest that it's heading in the right direction for the Fed to pivot their strategy?
Yes, to the last part of your conclusion. It's heading in the right direction. So the peak in inflation is in, and I think we can lay that to rest. The problem is it's sticky. It's going down, I think, not fast enough for the Fed to do any pivoting anytime soon in terms of actually cutting rates,
Sure.
right? What we're hoping for, I think what the market is hoping for, and they sometimes get out over their skis on this one, is that there's light at the end of the tunnel and they're going to cut really soon. It's going to take a much sharper drop in inflation for that to happen, and I think we'll get there, but the problem is that'll be with a recession, because a recession really brings down those prices very fast, and so be careful what you wish for. And even in today's numbers, which are lower than expected, definitely helped the doves on the FOMC committee. There are a few flies in the ointment, right? When you look at core services inflation, it's a little hotter than expected, and so the culprits are easy to see. It's wages are holding in there, and rental prices, housing inflation.
And I want to ask also, Joe, is it not only about extrapolation for the Fed? Of course, that's what mostly the market focuses on. But there's sort of a personal and consumer aspect to this as well. In other words, everybody here at this table is happy that prices are not rising as fast. And are there any implications for consumer spending?
There are implications for consumer spending. I mean, broadly in the first half of the year, the economy shrunk because inflation ran higher than expected. You are seeing real incomes compress. Living standards have fallen. That's why if you look at University of Michigan, it shows a recessionary reading. In terms of its level. If you look at the percentage of households looking for unemployment to go up next year, it's at a very high reading, to Lakshman's point about recession. So prices will come down. They are sticky, but they will come down if there's a recession, as I believe there will be. But for me, the Fed pivot might come a little bit sooner because I look for the labor market to weaken sharply, and my guess is the Fed will fold. They won't be as tough talking as they sound at the moment. Once the unemployment rate goes up into the low to mid fours, my guess is they'll start reversing.
Lakshman, do you think this data point gives the Fed, the breather or the room to pause, maybe earlier than the markets expect?
Pausing I think, sounds a little, it's like a bridge too far. I think slow. Which is kind of baked
25 basis points at the February meeting.
Or 50, I don't know. Powell's coming out tomorrow. Look, Powell does not want to be the second coming of Arthur Burns. He's made that crystal clear if you listen to him. And then if you think about Volcker, who famously came after and kind of broke the back of inflation, and this is Powell is studying this closely, right? And he knows that forecasts are rough. That's why he's kind of moved away from past forecasts and says, I want to see actual CPI falling. Now it is, but is it falling enough? Probably not. It's a little sticky. 7's a big number still. And then Volcker, I think, published a book called, the title was Keeping at It. Okay? So I don't think you're getting a big pivot very soon unless, as to Joe's point, you have the recession biting. If the recession's biting, look, if you're at a 4 handle on the unemployment rate, that's another way of saying you're in a recession. And that can give you some cover to pivot. Something could break. That could give you cover to pivot. But a 7.1% year-over-year CPI is not enough cover to fully pivot.
We had a guest earlier, Amanda Agati of PNC, say that this is the perfect storm of macroeconomic conditions, Joe. And if this is the perfect storm of macroeconomic conditions, what would it take for that to really begin to subside from your perspective?
I'm not sure what she meant by perfect storm. I mean, it's a very volatile, interesting market. It seems to me that the problem the Fed has is that as the market discounts a pivot, financial conditions, at least as measured by indices like the Chicago Fed, for example, are actually easing. So you've got financial conditions now by that metric, whether you believe it or not, it's another story. But that metric is telling you financial conditions are as easy today as they were when the funds rate was just 1%, which comes back to Lakshman's point about what does Powell say, because the more the equity market rallies in anticipation of the pivot with the weaker dollar and lower interest rates, he has a tougher job to do. But is that a perfect storm? That I can't say. The Fed's job has become more difficult. And unlike Volcker, people have to realize Volcker, when rates went up, the market technically was setting those rates. The Fed was very opaque back in the early 80s in terms of how they drove policy. The problem with Jay Powell today and this transparency is the Fed's going to be accountable for things that they can neither predict nor can control. So if I have to err on the side of where Jay Powell comes out, I'd probably say he's going to wind up being more like an Arthur Burns, because you could just imagine the political vitriol that's going to come up if we have a recession next year going into 24 with a presidential election.
I think this is a great point. The political pressure is huge. I mean, we know that, right? You've got an unemployment rate which is near record lows, and there's political pressure to stop doing what you're doing, right? That's kind of extreme. And that's our starting point. And so if the unemployment rate begins to rise noticeably, then the political pressure is going to get extreme.
Well, I mean, so you mentioned earlier that if we get up to 4% or so, that would be sort of the threshold. Is that the only thing that would give cover to Jay Powell to start to back off more meaningfully? Or, can he take cover under those loosening financial conditions or is there any other data that would be a trigger?
I mean, the unemployment rate, and Lakshman knows this, when it's up 50 basis points from its trailing low, it's always a recession. Assuming then if you're up at 4-something, 4.2, 4.3, 4.4, your non-farm payroll number is probably negative. And my guess is that, again, just like with CPI in the market, sees 1 week number anticipating 2. Now we've got 2. What happens if your next employment report, for argument's sake, is minus 100? Yeah. Maybe they don't go in February. I'm probably being too aggressive, but maybe they don't go in February.
Yeah, they're going to need some cover of negative jobs. I mean, look, 08 is interesting because you had negative jobs growth. You're 6 months inside a recession, and the Fed and the markets are looking at 100 basis points of hikes because GDP was still positive. Now we've got half a year of negative GDP, but jobs are positive. So we're like, there's no recession. I mean, even if people are calling for a recession, I know a lot of people are, there's like, it's later, or it's going to be mild, don't worry about it. And that's where you get really happy on the prospect of a pivot, right? I mean, also, lots of people have made this point, be careful what you wish for, because a pivot, the conditions for a pivot are obviously pretty bad.
Right, if unemployment's at 4.2 or 4.3%.
Yeah, they're obviously pretty bad. So now it's a betting game. Like, how bad is it?
Bottom line, you don't envy the Fed chair.
Hopefully it doesn't get that bad. I'll leave it there. Joe LaVorgna,
Yeah.
SMBC Nikko Securities America Chief Economist, along with our very own, or our friend of the show, Lakshman Achuthan, Economic Cycle Research Institute.
Did you just hire Lakshman?
No, I kind of did. I mean, friend of the show. Love talking to this guy. I love him.